Today we're going to discuss the details across our $1 million portfolio and how we're creating well over $4,500 a month in passive income today to cover our living expenses related to our rent and our utilities, and still leaving the rest of our investments to grow for our retirement. And today is unscripted, a bit raw. I have a lot of stuff to walk you guys through, including the value of our accounts, the intention behind the structure of the accounts, the asset allocation, the returns that we've seen to date for all of the accounts, and the 4 investments that are creating the $4,500 a month passively. So lots of different files. Stick with me here. And if you're new, hi, I'm Stefanie. Welcome to Permission to Be Wealthy, where we talk all about investing for financial independence with balance. And that includes this $375,000 Covered Call ETF, income-oriented account, and the rest of our investments that are positioned for growth. And be sure to stay to the end because I'm going to talk about what we plan to do with BTCI. Because as you may all know, and if you've been watching the news, Bitcoin went all the way down to 63,000 yesterday, and it had an impact on the funds. So be sure to stick around for that. And before we get into it, I want to remind you that this content is for educational purposes only and not financial advice. All investments carry risk, including the potential loss of capital. Past performance is not a guarantee for future results. Please consult a certified financial planner before making any investment decisions. Okay, so our overall accounts landed at the end of January. I pulled this information at the beginning of February, the 4th through the 5th. We have accounts across Fidelity and across Vanguard. 3 accounts in Fidelity that are primarily our retirement accounts, and the account that holds our income-oriented portfolio, and then the account that sits in Vanguard, which is all positioned for growth. So across Fidelity, a little over 857,000, 351 as that Covered Call ETF account. A Roth and a traditional IRA, that's about 506,000 overall. And then the other account in Vanguard that's all positioned for growth as well is 388K. So think of the right-hand side, all growth stuff, and then the left-hand one account over here as the income-oriented account. And let's talk a little bit about structure. So 27% of our overall assets is in this income-oriented side. And I did a video last week that talked about 2-bucket strategy, whether you're retiring early or retiring at a traditional retirement age. The choice is yours, right? But this active income strategy for us is intended to generate or at least replace the old income that we used to get from our rental home back in Texas. So when we sold that back in 2022, when we moved here to Portugal, we were looking to replace that passive income some way. And through our research and obviously amazing people here on YouTube and doing other kind of conversations with different planners, we learned about Covered Call ETFs and felt like that was something that could fit as a tool in our overall strategy. Our base is to generate the $3,300 a month, and we believe that we'll land around the $4,400 to $4,800 a month throughout the course of the year, because we also added a little bit more of a risky option, which was the BTCI fund, and anything over the $3,300 a month is either going to go towards reinvestment or helping to fund our lifestyle or other things that we have the choice to do with that income. Then the rest of our assets, or the investable assets, 67%, is all positioned for growth. So the retirement accounts, a little over $500,000. We intend those to get to over $2 million by the time we're 59 and a half, and then at least $3 million by the time we're 62. And we just keep those 2 numbers in front of us because we could start withdrawing out of those accounts at the age of 59 and a half, or we could wait until the age of 62. We have the choice and the option. We may very well wait till 62, but we'll see how that goes. And then the non-retirement account that's positioned for growth within Vanguard, almost $400,000 today, and we really want that account to continue to grow. We want to leave it alone all the way until we're at least 50, and we could decide to start withdrawing from that account if we choose to, or rebalance it however we want. And then we do keep a cash reserve. Many of you know that we live here in Portugal, and the foreign exchange situation is real, right? So we have to manage converting currency from USD to euros. So having cash both in the US and in Europe is really important to help us manage through that strategy. Plus, the market has been pretty volatile. So making sure that we don't have to access any of our capital in a down market is really, really important. And I want to remind everybody, we're not fully retired. I did leave a large, high-paying job that I was in for 15 years because we had invested enough to reach a point where I felt comfortable doing that. And while we are still doing some level of work, that work is on our terms. We get to design our schedules. We get to figure out how we want to work and the type of work that we want to do. So we are generating some level of passive income from our investments, and it makes it a little easier to sleep at night because we know that many of our bills are covered and the rest of it we figure out. So we are invested in a series of index funds that track the broader stock market, right? We do have a few individual stocks that are primarily in tech, and there's nothing really to write home about those, to be honest. So around 5% of our overall asset mix. We still have that cash. Crypto is in our income-oriented account through BTCI, as well as IBIT as an ETF that is in one of our Roths. We do invest in the total US stock market, the S&P 500 and the NASDAQ 100, which will go through the detailed funds specifically on the income-oriented side. But think of things like BTSAX on the growth side of our accounts. And it's really allowed us to just not have to worry too much about the steady Eddie stuff. Okay, yes, there is some market variability and volatility, but by and large, we're really happy with those choices. In terms of overall sector mix, our top mix is tech at 31.6%. Longer term, whenever we're inching towards retirement, I would like that to get to closer to 20%. But right now, because we're still very much in a growth phase, I'm okay with that. We do want to introduce international funds over time. And crypto right now, we were starting with about the 5%. And I could see that going up to 10 to 20% of overall mix as time progresses. But that's where we are with the overall mix of our sectors. So now let's talk about performance and results. So the IRA that we have is the old 401k that I started when I was 22, when I started at Dell. Thank you very much to the HR lady who helped me set that up. But that was originally in a target date fund. And when I was coming out of working for the company and just looking at what the TDF offered and the performance it actually generated over time, I knew that I wanted to move it into something else. So we moved it into a mix of S&P 500 and total US stock market around 2023 whenever I rolled the 401k over into a self-directed IRA. The Roth is also in a mix of those two type index funds as well. We have the two brokerage accounts that we opened in 2021. So we got really, really intentional about learning how to invest with more purpose in 2020. And we opened new accounts in 2021 and really started shoveling a lot more of our money into those accounts because we were maxing out our IRAs at the time. And we started partially living off of our investments in 2023. So when we moved to Portugal, we had a set of cash allocated aside, but we knew for about 2 to 3 years that we were going to actively withdraw from our account. And we weren't going to do anything like 4% or 5%, maybe a percentage, because we also had the income from the Covered Call ETF account that was generating income for us as well. So if we look at the growth accounts, this is the IRA, the Roth, and the brokerage. We have realized and non-realized gains because we've taken withdrawals from the account overall. So the original cost basis for the accounts overall was about $1 million, and we've accessed $1.4 million in withdrawals, gains, and what the current gains are unrealized today of the account. So 42%, not too bad. And you can tell the set it and forget it stuff that we're not touching is doing really well. So it pays to leave stuff invested for the long term. On the income side, we have realized the distributions as well as gains or losses whenever we have remixed in and out of things in the account. And so we've seen about 27, almost 28% overall total return, primarily because of the income generated from the account. And overall, if you combine all the accounts together, a little under 40% of overall total return. I'm happy with where we're headed. And when I get to put numbers down like this, it makes things a lot more clear as to the strategy that we had in place and actually seeing that happen real time. And it's worth taking the time and effort to do that. So let's talk about now the income focused account, because a lot of the videos that we create here on this channel are focused on that. So we initially started investing in Covered Call ETFs back in 2023. At that time in the US, there weren't very many options. I would say in the last year, hundreds of new options have come on the market, some efficient, some not so much, in my opinion. At the time, Global X and JP Morgan were more the steady Eddie providers of some of these Covered Call ETFs. So we invested in the S&P 500, the NASDAQ 100, the Russell 2000 equivalents of these funds via Global X and JP Morgan. And we really just left it because we were living off of the income. We were also dealing with a lot here in Portugal, settling initially in Lisbon and then moving out towards the broader Cascais area. But in 2025, which I've made videos about this, I'll link them down in the description below, we really started evaluating some of the more efficient, in our opinion, fund managers that were bringing new Covered Call ETFs to the market. And that was primarily building a lot more opinion for me to say, I think it's time to make a change, so that not because we're chasing yield, but because we want to have funds that fit our strategy more holistically, if that makes sense. So we moved from those original funds. We did decide to kind of step up to the Global X Growth funds at the time, so QYLG and XYLG, but we quickly realized that the distribution yield was primarily driven by large distributions that were happening at the end of the year. And that inconsistency, like I've mentioned before in other videos, didn't work for us. So we ultimately landed on 4 other funds, JEPQ, SPY-I, QQQI, and BTCI for our income-oriented account. And so now I'm gonna ring over the overall file for our income-oriented account. And just a couple of quick reminders. So this account is in a taxable brokerage, and we want to make sure that we are maintaining tax efficiency, we are generating income, that we can maintain the value of our assets, specifically for the steady and the enhanced income positions, as well as understand that we do have a more risky position that we've taken on, specifically through BTCI. And that's more, I won't say the speculative, but the one that we are willing to take more risk and understand that there's going to be some volatility and variability behind it. The other thing about the BTCI holding is that for crypto in general, we don't want to have any more than 5 to 7% overall mix. And in the case that the market is down, we do have the lever of being able to reinvest the income from that specific fund or some of the other funds as well, or any of the other active income, so that we could take advantage of the fund being at a discount. And so we've invested about $382,000 into this fund overall. And of the 4 funds, just to kind of break down what they are, QQQI has NASDAQ 100 as the base index that it's invested in. It writes out of the money calls. So whenever call options are being written, let's say that the share of QQQ is $100, they may write a call for 105 or maybe 110, right? That's just trying to put something into plain English to understand out of the money versus at the money. At the money is kind of the same price. There are premiums generated from that. There is more upside capture on the portion of the fund that are being written calls on, and they only write about a quarter of the fund, write calls on a quarter of the fund. So that means that the rest of the fund is able to continue to grow, and that ticks the box income and kind of growth, capital preservation, if you will, in terms of our strategy. The other thing is this is in a taxable brokerage account. So when we get paid ROC distributions, which aren't necessarily bad ROC, they are just tax treatment because of the way that they harvest gains and losses. That is a benefit, a tax deferment for us whenever we receive income classified as ROC. SPYI focuses on the S&P 500 and the whole S&P 500, not just a portion, because for JEPQ or JEPE rather, and I did a video on that, JP Morgan chooses funds within the index that are less volatile to create some stabilities, right? So we want access to the full fund in most cases, and SPYI does that for us. JEPQ focuses on the NASDAQ 100, again, selecting the less volatile, not of the S&P 500, the less volatile of the NASDAQ 100 funds, and they still use out-of-the-money call strategy. It's not clear exactly how much they're writing calls on, but the assumption is that they're writing calls on majority of the portfolio, and they are generating bona fide income. So they want you to know come tax time that these are dividends, non-qualified. They are going to go towards your tax bill so that it's not confusing, if you will, to manage your taxes on the back end. And then, of course, BTCI, it is pegged off of IBIT and HOLD, which are ETF equivalents tracking specifically Bitcoin. So if I go and I look at how each of these is running, this is the S&P 500 version of this. You can see here where QQQI is in orange. It's tracking very well against QQQ here at the top. And I would expect this kind of mirroring, right? I would likely want to see JEPQ mirror almost the exact same, but you can see why we went ahead and decided to move away from QILD down here at the bottom. Then we have SPYI. I use VOO to track it as an index and doing really, really well. You can see why we moved away from QILD, and I did a video a couple weeks ago why JEPE has not been doing as well as SPYI, primarily because of the way that the fund is structured and the way that JP Morgan is self-selecting specific funds within the S&P 500 and not being able to capture all of the upside that happened in the S&P 500 back last year. And then we'll go to the BTCI version. So I always get questions on this. Like, what are we going to do with BTCI? The market is down. Like, isn't there unlimited downside risk with this fund? And if a fund manager was creating calls, non-covered calls, there would be unlimited downside because they'd have to go out into the market and purchase whatever they need if a call was actually exercised. But when you are writing covered calls, or these fund managers are writing covered calls, there is downside risk, but not unlimited, right? Because they own the funds and they are able to cushion some of the downside that could happen in the market because they are generating premiums. So right now, BTCI is a little ahead, right? 31% negative in terms of total return for the last year compared to HOLD and IBIT. I would expect that this would maintain if the market continues to be down. And I'm looking forward to seeing, how this continues to play out. Of course, we got a little bit of a test with how BTCI would perform in a down market last year in April, and you can see that it did pretty good in coming back. I also track what we're doing every single month when it comes to our funds, especially if we decide to continue to reinvest in them. So when we bought BTCI, we bought it last year in July, and the price per share was $64.87, which was very much a premium, not a discount. And so as BTCI has come down in terms of price, we're just continuing to dollar cost average. Every single month when we receive distributions, I make a decision on if I'm going to go ahead and continue to buy. We're not just automatically reinvesting, but we're making active decisions on what we want to do. And in some cases where I feel like I want to create a limit order, we'll do that. So back in December, I bought about $2,500 in BTCI at 47, almost 47 a share. In January, 2 specific limit orders were executed at $45 a share and $47.75. So was able to take advantage of that. I bought another $2,500 yesterday at 33.7, and I set another limit order for if BTCI goes to 30. And I just want to remind you, our decision to invest in BTCI was based off of our risk tolerance. So if this is something that you don't believe in or really doesn't help you sleep at night, by all means, don't choose a position like that. But that is more of the volatile speculative investment that we have in our overall portfolio. Of the 382 that we have invested in overall, the current value is 372. And this is as the end of month January, so about negative 2%. We have generated negative 15.5K in losses, which was really when we did the shift last year. We have generated a lifetime income of 130K, so 115,000 overall of realized profit, right? Not the stuff that's still sitting in the accounts, but realized profit, so about 28% overall. And with what was generated in income last month, we saw about $4,699 in our accounts. And based off of the 12-month annual dividend, we expect 15.3% of distribution yield out of the account. And this is based off of our cost. And if we're looking at only last month's dividend, or last month's distribution rather, we'd expect about 14.3% distribution yield. Why the two different distribution yields? So I come from a background of planning and forecasting, and it's really important whenever you're looking at data points to build some level of consensus. So when Joseph and I think about the whole year, we go back and we look at different variables, different scenarios. And so when it came to looking at the income from this account for this year, I took a look at what have been our projections for the last 6 to 7 months. We've talked about many of these projections here on this channel. I look at low, baseline, and high scenarios, and I just build a range for where I think our income is going to land monthly so that we have a better sense of kind of what trigger points could be and what we can expect for the overall year. So I'm thinking 4,600 is going to be the average for the year. Lowest if we really see the distributions from BTCI go down around 4,000 to 4,100. But that's my call for now. I don't have a crystal ball, but these are my best estimates based on the data that I have available. And I would say one other thing. So when I think about that 3,300 base that we want to generate in income from this account, and then everything else is bonus, right? If I go back and I look at the distributions from these specific funds over the last 6 to 7 months, SPYI, JEPQ, and QQQI have generated about 3,100, 3,300. So we're very close to that baseline being absolutely met. and anything else that the account generates above that is up to us to be able to either live off of or reinvest back into things like BTCI or whatever else we choose. So with all of this said, I think it's really important that we think about the long term whenever we're looking at our investments. Even in times of volatility, it's important not to panic. You have the choice, right, to panic, or you have the choice to put your head in the sand and just ignore it all, or you have the choice to stay focused and understand what you're actually invested in and either choose to keep going and keep investing so that you can take advantage of what is in front of you in terms of the opportunities that are there. What helps me is having a long-term plan. So I have a file that has a 10, 15, and 20-year plan. I pay attention a bit more to the 10-year plan because that's a little bit more of what I can control. I automate my investments where possible. So in my other growth accounts, all of the dividends are reinvested. When we were actively shoveling a lot of money away, it was all automated. I was never seeing it in my paycheck. And we have a cash reserve for places and times when we may need the cash and not feel like it's a right time to pull money out from our investments, right? And that's sound retirement planning. And please stay out of the news and outlets that are really just trying to get you to click on things because they want you to fear things. And if you can, stop checking, your investment accounts every single day, because if it's not providing a lot of value to you, it's probably not worth it. So when you're thinking about investing in something, I want you to ask yourself this question: can I stick with this plan or these investments in both good and bad times? And if your answer is yes, then you likely have really thought through all of the different things that could happen in the contingency planning and the good things that you're investing in. If the answer is no, then you probably have a lot more questions than answers, and it's important that you figure out how to go get those answers. And so if you're interested in how this 2-bucket strategy works, kind of combining income and growth investing, I did a video that helps you understand how a 2-bucket strategy would work for $1 million, $1.5, and $2 million last week. So you can check that out. I'll link it in the description below. If you're also getting started when it comes to covered call ETFs and just trying to understand the sea of information that's in front of you, I also have my Income 360 file, and that allows you to take a look at over 80 funds categorized and organized for you. It'll save you hundreds of hours of time. You can take a look at all the dividend income, distribution income details that all of these funds have, and it can help you do annual planning. The file will also help you understand what reinvestment options you have if you choose to reinvest a portion of your dividends or distributions rather. And there are top 10 lists in there that will help you really understand the importance of total return versus just chasing yield, right? And I think that's a really important part of the file, because by all means, you shouldn't just be chasing yield. You should be really thinking about going after funds that have sound structures that you can keep for the long term. And of course, I hope today's video gave you permission to be wealthy. This was a little bit of a different one, but I really hope you enjoyed it.